I think it would be great just to start. I mean, you've done some very interesting work in this whole topic of full reserve banking, the Chicago plan, which we've touched on before on this program, and also on digital currency and potential models for central bank digital currency, which I find all interesting and perhaps not coincidental. But I thought it'd be helpful just to kick things off to have you kind of take us back to the 1930s for a moment. Take us back to Irving Fisher's 4 principles of 100% money. This idea that we could see fewer and shorter recessions, less public debt, less private debt, no bank runs, a much different inflation situation, and you later argued higher output. So maybe just take us back to that set of ideas, and we can kind of help the audience understand that.
Okay, very briefly, I will tell you about how I got back to that set of ideas myself. They started when I was working at the IMF. And around 2006, I was getting very concerned about what I was reading about what was happening in the US financial sector. I had previously worked with Barclays for 5 years. And at that point, I started reading a lot about monetary systems and the history of monetary systems. And what I came across as a key reference is a very short booklet by Irving Fisher, 100% Money and the Public Debt, which I then proceeded to model, because that is my full-time job, is basically to devise macroeconomic models that help us to think through macroeconomic mechanisms. And so basically the key notion in that work by Fisher and his contemporaries was that the Great Depression, one of the key problems was a shortage of a medium of exchange. He called it the circulating medium. The fact that banks create that medium of exchange by making loans, and that is how the majority of the medium of exchange is created, especially today, but even at that time. And the idea that this could create financial instability, first in an upturn, because banks can make new loans by creating new deposits without having to worry about attracting new deposits from somebody else first. That can lead to lending booms, or can make lending booms easier to kick off by the banking system. And then in a downturn, bank loans start to default. Banks start to lend less because they're more worried about the risk. Both of that destroys bank deposits, and the destruction of bank deposits is the destruction of the medium of exchange, precisely at the time when they are needed the most. That was one of the ideas of Fisher, but the other idea was that in order to create the money that we use, and this is more true than ever, we need debt, because the banks can only create money by somebody going into more debt, getting a loan, so that the proceeds of the loan can be credited to his or her deposit account, meaning that if we want to create enough liquidity, it has a flip side, and that flip side is increasing debt. So the Chicago plan idea that Fisher laid out so well in that short booklet consists of the separation of the monetary and credit functions of the banking system. In that system, the central bank would be the sole creator of money, and the banks would only be the intermediaries of money. They could no longer create deposits by making loans, but instead would have to attract sufficient deposits of money first before lending them out. And that plan, I should emphasize, was an idea of who were, in essence, the founders of the Chicago School of Economics.
Yes.
They were very laissez-faire for industry, but at least in those days, they found that a prerequisite for efficient laissez-faire in industry was that when it comes to money creation, there should not be that kind of laissez-faire, and this should be handled by a central bank, by the authorities. Right. And I was able then to basically confirm Fisher's conclusions, the ones that you already outlined, a better ability to handle financial cycles, financial crises, less debt, because when you issue money under the Chicago plan via the central bank, you issue it basically as a token that signifies this is something you can purchase something with, but there's no corresponding debt. So lower debt And the output gains that I came up with had something to do with the fact that this would be an economy where everybody would be less leveraged, far less leveraged than today, including governments. And lower leverage typically implies a lower real interest rate, and a lower real interest rate implies more capital accumulation and more economic growth.